And when we left off on this last chart, we were talking about this is a monthly bar, this is Continental Airlines. We got into a discussion of, is smart money accumulating positions in airline stocks right now? And I think from the two that at least we looked at so far, and I did some stuff just looking at charts that I normally do anyway to look at market. We've got kind of a sector rotation going on, it looks like, that I'll talk about a little bit and then get back into this candle volume analysis. But if you look at your transportation stocks, those have been on a parabolic up move, and those look like they're being sold right now. And I don't know how many people here watch the Dow theory. Any Dow theorists here? Got a couple? Dow theory tells us that, right now that the Dow transports haven't really made lower lows, although the Dow has. So that would tend to say the transports aren't following the Dow. We're going to expect the Dow to go back up again. But if we've got the sector rotation, it looks like it's going on in the transports right now, specifically shipping, then that would not portend well for the Dow Jones Transportation Index, which if that started following the Dow Jones Index, we've got some trouble brewing. Another thing, just side note, I like to just interject this stuff as I think about it because I don't script anything other than my PowerPoint to start this. But if we want the market to go up, right? And most people we're really going to make money when the market goes up because all of us have retirement accounts, or most of us do, and very difficult to short in your retirement account. So we would like to see the market get through this and start on its way back up and create more wealth for us in America. What we got to be careful of historically is if we come into this summer session and we make higher highs for the year in the summer session, that does not bode well for higher prices the rest of this year. You don't want highs being made in the summertime in the stock indexes. You can look back through history just to prove this for yourself. But that's the last thing we want. We want, in talking about the health of the market, we want the market to fall hard this summer if we want a stronger market later on. Because if we have a strong market into the fall and we make higher highs this summer, going above the highs that we had during the beginning of this year, we've got bigger problems brewing, historically speaking. I'm not an economist. I don't do that part for a living, but it's things you just need to understand history. Highs being made in the summertime are not good for the stock market in the future. But anyway, back to this chart, Continental Airlines. We've got this doji no demand bar, and this is followed by, we could call that, and I said I wasn't going to talk about a lot of names. What is that? Oh, you wouldn't even know probably because I didn't describe it. That's a gravestone doji right here. But the experts say that, some of the experts I should say that you can't have a gravestone doji on the top. Gravestone doji can only be on the bottom. We could do a fuzzy candle thing and say, well, that's a shooting star, which is the next thing we're going to start talking about. Actually, it's the second next thing. We're going to talk about hammers and then shooting stars. But when you look at this, what's going on here is this is portraying a message to us. We had an uptrend on a monthly chart. We started out down at 14, right to where we are now again. As we went up, we made a high of 50. And you can see as we went up, that thing started to get parabolic. You got to be careful of markets that start to go parabolic, right? They're not going to last. They can't. That's when the hysteria comes in, and that's when all the professionals are getting rid of it, all the public's coming in and buying it. That's what's happening in the transports right now, at least the shipping companies in the transports, something I'd encourage you guys to go look at. But you can see what happened from that, right? Could you take a trade right from that doji no demand? Depends on your time frame, right? If you're a monthly trader, you closed at 41, it made a high of 50. I think even a monthly trader is going to get closed out of their position. I would hope. That's almost 20%. So it's just alerting you, right? This is alerting you. It's different than doji tests. Doji test is a different decision to make than a doji no demand. Doji tests, we can rely on the low of that doji test bar not being taken out. If it's taken out, we're out. We can't do that on these doji no demands. We can't say, well, I'll just put my stop at the top of that. You will get your butt handed to you. You won't make money in the long run doing that. So you can't do that, but what we can do is use these things as filtering techniques to look at stocks and say, okay, maybe I've got 10 stocks I'm looking at. I'm thinking of buying one, or I'm thinking of buying two. put on a monthly chart, just start looking at doji no demands, doji tests, line those things up first to help you make your decision. If you see a doji no demand, you're going to say, well, I think I'm going to pass. I'm not interested in buying that. If I short stocks also, I'll now put it on my watch list because I know most likely at some point in the near future is a nebulous term, a month, 2 months, because it's a month bar, we should have a potential short setting up. And that's how you develop your watch list as traders. If you look at charts and you just run through on one Saturday a month, you might do your monthly charts. I think every Saturday or Sunday you need to do your weekly charts. You've got to look at what happened during the week. And you look at the same thing, right? Doji no demands, doji tests, and when we get into the hammers and the shooting stars, we're going to start looking at this stuff, and now things are going to make sense that maybe didn't make sense to us before because we were just looking at oscillators and we were looking at moving average. Oh, we're at the 50 moving average. Oh, yes. You know, and there's a lot more to it than that. Okay, we're going to hammers now. We all remember what a hammer is, right? Small real body. On the upper portion of its range, we can only have a little 10% of that little hair on top or the little wick or the upper shadow, whatever you prefer to call it. And it has to be, that lower shadow has to be at least 2 times the size of the real body. Those are the rules for a hammer. Sometimes when you get something that looks like this, and I had to scale it like this so you could see the extent of the down move, you would never want to have your trading chart scaled like this. It's making that thing seem too squat. If this wasn't a photo, I could send it out, and you could see that shadow below is 2 times the size of that real body, and that you've got something going on there. And what's going on there is what? What do you have in the near background? And this is where the nuances come in, because yeah, you've got potential strength coming in, but I wouldn't call that a selling climax. It's not, because you have 2 high volume bars right after the other, but what you have after that, which is the bar we're on, is key. Where did the sellers go? If they're there, why did it close back up here? Why did we start here, go all the way down and close back here? How can you logically describe that if you're thinking how smart money's thinking now? How does that happen? Well, it had to mean that there was some buying in those previous bars. It has to mean that. Now, hammers are great also because they provide support. I don't like it as much as a test, but this is a doji test rather. But this is close because the body is still pretty small, right? When you get the bigger body on the hammer and you get a bigger tail on the bottom, it becomes a little scarier. But you can still take a flyer on something like this if you wanted to as a Coca-Cola Daily. When I say a flyer, I don't mean to be flippant. You can't just make stupid decisions and say, oh, I'll just buy that because that looks cool. You got to do more research, right? So I don't want to make it sound that flippant that you just take a flyer on it. But you know, when you really look at it, you've got a close of 56.15 and a low of 55.83. So what is that, 40? It's like 32 cents on a $50 stock. I mean, what's the real risk? There's not a lot of real risk. You've got this thing coming down. It did increase in velocity, in price, and in volume. We saw the stop part of it anyway. I mean, you could call that stopping volume. Wyckoff could call that stopping volume, but it really wouldn't call it climactic action necessarily. But you can see that there's some buying that had to come into that for that hammer test to show up. But the test, we use the bar. If I'm wrong, right below that bar's low is where my stop sits. It's not a big risk trade. And when you start looking at it that way, it becomes less scary to take these trades. You don't have a lot of risk. You've got what looks to be strength coming in the market. Otherwise, that thing would have kept going down, and it didn't. It made a new low, but in making that new low, where did the sellers go? Can we see them? We can't. If we can't see them, and we got a pretty close stop we can use, that's what I mean by taking a flyer. You know, I'm not going to establish a huge position on this, but if you were trading stocks, you're looking for something to trade, or maybe we'll flip it around and you're a day trader again, trading stocks, this is going to be something that you can say, I've got a directional bias for tomorrow that I'm going to trade with. I'm going to trade on the long side. I'm just going to let this align my positions for tomorrow, so when I'm around support tomorrow, I'm going to be looking to buy support. When it's showing weakness and it gets up around resistance areas, you're not going to short it. because you think there's strength behind it. You're just going to let it go. We'll let it come back down, hit support again, and look to buy it again. That's how we can use this stuff to filter information for us. So it's really, really important that way too. But when we look at this, it went from 56 up to 59, so $3 a share. It's not a lot, but if you're day trading, that can be quite a lot if you give yourself a directional bias. There's another hammer test. Now, that hammer test, we look at it, comes right after what looks like a doji, not quite a test, not really quite a doji test, but it's going lower again, but in going lower again than the previous bar. And again, just to make sure you're all with me, I'm talking right here. Where did the sellers go? They just don't look to be there, do they? We don't really show any signs of selling. The previous bar went down, and it went down on lower volume. This is kind of why I like the e-signal way of doing the volume, saying, I know that the volume on this bar is lower than the volume on this bar because it's red. Something real simple, visual. You may not have e-signal, but you may still have the capabilities on the charting package that you use, that you can make your chart look like that chart. And it just makes it easy for us to say, okay, it's got lower volume. So it's going down on lower volume, and I've got a nice tail underneath there. So we went down, we came back up, but in that case, it wasn't the end. But see, we didn't have, one of the things that we'd like to see is volume, not just less than the previous bar, but less than the previous bars. And we didn't have that. But we certainly have it here, right? This volume is less than 1, 2, well, it's the lowest volume bar on the chart, right? So that's got to tell you something. Just like a really high volume bar speaks languages to you, if that's the lowest bar in your chart and you're starting to see the velocity change, you're starting to see the momentum change, if you will, and you got to look at that and say, okay, now I've got a hammer test. This is a E-mini S&P. Closes at 1392, low is at 1390.50. You got a 0.75 stop. It's worth taking. I mean, it really is worth taking. It's not perfect. It's not perfect, but I know the E-mini. I know what happens in the E-mini, and they like these tests. Hammer tests, doji tests. And what you got to be careful of is you're not going to the moon. We're not looking for 25-point moves. This is a 15-minute chart. But we went from 1392 up to about 1399, close to 1400. 8 points. 8 points in E-mini is a very good trade. And we had some movement against us, but we're going to talk about that, how we trail stops, so that when you're in a position, we don't want to cut the profit short, but we don't want to have it come all the way back on top of us either and lose money. Don't let winners become losers. Okay, another hammer test. I'm going to speed this up a little bit because I do want you guys to have time with Ryan. Another hammer test, same kind of things we're talking about though, really. There's no difference, but when I say no difference, the pattern looks the same, but the chart isn't the same. This chart has something that the second chart, or the last chart we looked at didn't. And that is, we've got the selling climax. See, that's one bar. The velocity increased on both the price and the volume, and then it stopped. We came down to test that range, and there's no selling. With tests, and this again is the E-mini, this is a 30-minute chart. With tests, we know that we shouldn't take out the bottom of that range of that bar. We can't take out the bottom of that bar, otherwise we're going to have a failed test, the market's going to show more weakness. So you see something like that, you got the strength showing in the background, that's one that you've got a nice trade. The reasons I say that is we're testing this area where this came in. What we look at, what most people would look at that aren't trained Wyckoff analysts, they would look at that as very weak. I want to go short on that. I love shorting that, they're going to think. Look at all that negative volume. I mean, that's so negative on the market. Look, everybody must be selling. That's the thought process that goes through people's heads, but it didn't. I mean, it stopped. So that's got to be a clue right there. If nothing else, it's, hey, did it just stop? Okay, shooting stars. And this is going to conclude what we're talking about with candle volume analysis for about 5 more minutes here. But we've got the same thing. Shooting stars can only happen where? The top. We can't have a shooting star on the bottom. It's not a shooting star if it's on the bottom of a chart. You can have shooting stars, and some of the experts will say if you have a shooting star, we would like to see that shooting star pattern bar gap up from the previous bar. So we would like to see I'll get it back then. I just want to draw it first. I am off the screen. Do you see how this open gaps above this close? That's what the experts would say. That's to get a nice shooting star, you really like to see that. I agree with that. It's just going to show you that you've got a little more conviction. Usually that's going to happen in a daily chart. It's going to be more of a daily, weekly thing than it is a 5-minute chart. But when you see that, you just had people have time to kind of collect their thoughts. The market closed, and now either the specialists or whoever these professionals are that are trying to get you to buy it, they have their time and they mark it up, and then you come in, the news is created from, oh my God, this, you'll show up on the big volume or not volume leaders, but necessarily, but price movers. It's going to show up anybody doing screens like that. And they're going to say, okay, I like that. People look for gaps on the opening. That's another way to trade. Stock traders trade gaps on the opening. And that's the best way to fool those people, is to gap it up, get you in, and now you're buying what they're selling. That's how this stuff works. But now we have this thing that this is not a gap up, right? And this is a monthly chart. So we could have had a gap up. Oh, thank you. This one's not a gap up. But it is a shooting star. And this moves up, but where did the volume go? It's gone. Does it mean that this market's going to go in the tank? No, because you got to look at the background now. Now, what's behind it? Do you have the buying climax? No? No buying climax here, right? We're going up. You got a lot of volume here, but that doesn't tell us anything about over here. And coming up here, you don't really have anything unusual. You just got a shooting star, no demand. On a monthly chart, you're going to at least expect that thing, the next bar, to go down. I would expect that. Shooting star, kind of like that test, though. Shooting star, that top should be what? Resistance. The top of that shooting star should be resistance. The problem with that formation is the wick or the shadow is usually a lot higher than the close now. So now you got a bigger risk trade if you're going to use that just by itself, or you say, well, I'll put my stop right above that. Well, you can, but it's not as nice as that test, because the test usually isn't going to have a big long tail on the bottom. The doji test usually, especially. A hammer test could, but a doji test probably not. So you got to be careful with this, but you do expect weakness to come in, and it did. And what do we have here? This is a trick chart. It's not a shooting star. Thank you. I want to make sure I keep you guys awake, because we can't have you just go to sleep. So we got to put some tricks in here. But no, that's not a shooting star. Looks like a shooting star, but it's not, because it's not at the top. We don't have an uptrend behind it. We have a downtrend. You can't have a shooting star on a downtrend. They don't exist. You could make a case that's a gravestone doji if you wanted to start talking about that, but I said I wasn't going to talk about that, so we're not going to talk about it. But this is where the little nuances come in, and you got to know that that's not a shooting star. It can't be a shooting star. There's a shooting star, no demand, and that's a GMT is a symbol. It's a monthly chart. And what I hope you start to do is say, look, on these monthly and weekly stock charts, when I start to see these things, I certainly do not want to be long in these. And if you guys are trading stocks, you need to look at this stuff every week on your weekly charts, every month, at least for every position you have. Right? Why keep something that's going to turn into a dog? You don't know if it's going to be a dog forever, because again, on this, we don't have a buying climax behind us. But we know on a monthly chart, we're going to expect the market to either go nowhere or go down, most likely, from this kind of formation. It's a shooting star. It went up, and then it came back down. For some reason, it came back down. It did it on low volume. But to me, and you can see that's a gap up shooting star, right? The open of that is higher than the close of the previous bar. So we had some good news carry through from the 1 month to the next. It got some people interested. We don't know what news story came out on this, but I can pretty much assure you there was some story on it to get the people involved doing that. right? Otherwise, you wouldn't see that formation on the chart. So we know there's something going on behind the scenes. We just don't know what it is. But that alerts us to the fact that, hey, if I own this, I don't really want to own all of my shares anyway. I'm going to get rid of some, or I'm going to put a tight stop on it. I'm going to do something different than just sit there with it. And if I look and do a lot of portfolio rotation, so I may be swing trading, I don't want to have that stock on a long trade anymore. I'm done. At the very least, that can tell you that. It can set up your directional bias if you're a day trader of stocks. If this was a commodity, which I'll show you in a little bit, it can set up your bias in commodity trades. So that's a nice thing. These are not just trade right now with this information. This is information that you need to keep in your memory banks. And more important, somewhere either written down, or if you're an organized person on your computer. I write things down. I go through computers, but I'm an old-fashioned guy. Everything's on paper for me. I just keep it written down because that's the way I work. But you need to know, you have to have a list of things that you watch that could become a trade candidate for you. And if you've got a program you like to put in, Telechart's a good one. I do put things in Telechart too, but yeah, and you just keep coming back every day and watch it. But with what did I say this was? This is a different chart. This is a British pound. This is Forex. I read that wrong. I'm sorry, this is a Forex chart, 15-minute. And I did have a talk at lunch at the table, and we talked about, well, what do you do with Forex? Because obviously Forex it's got no central exchange. There's no volume reported on it. That's all true. There's no volume reported on Forex. But we can look at trade activity, which is what eSignal does. Look at the activity, because all volume is activity, right? We're seeing how much activity is involved. The disadvantage, if you want to call it that, with not knowing the traded volume is that we don't know. Maybe one big player came in and put 10,000 contracts in. Sure, we don't know that. But what we do know is when this thing starts ticking, we know that the retail trader's ticking, and we know the professional trader's ticking, because at some point when all that goes up and spikes, we got to have both sides disagreeing on the price direction. We've got transfer of ownership, most likely. So even though we don't have traded volume, tick-based volume in Forex is nearly the same. It's telling us that there's a lot of activity or a little activity. This is a 15-minute chart. This is just before Europe opens. This is a good example here to show you, though, that that's high volume. You'd look at that chart now, and now you can see the whole right side, and you say, well, no, it's not. But remember, you can't look at charts like that when you're trading. You don't see anything past this. This is the highest volume on the chart. And look what happened. It's a shooting star. And it's coming back and collapsing, and it gapped up. You don't see gaps in Forex very rarely. So that's extremely bearish. And you can see from that price around 197.90, it went down to about 196.90. It went down 100 pips. So this is on a 15-minute chart. This is how powerful this stuff is when we start looking at Wyckoff volume analysis and apply it to candle volume, or candle charts rather. Here we go again. This is a high volume. So shooting star high volume instead of shooting star low volume. And what does that tell us, do you think? If it's high volume and not low volume? Say again, louder. Yeah. We went up, right? This thing got pushed up, and it looks like it went to a higher level than the previous left. And when we went up, we had a lot of supply coming in, and it pushed that thing down. And what you can do to verify that chart, because this is a weekly chart on Conway, is we can go again like we talked earlier and break that bar down. So let's look at a daily chart. Let's look at a 60-minute chart. Where did that volume come in? If we can go and confirm on that weekly chart that when we got up here, right up at the top, that's where the volume came in and pushed that thing down, then we know that that's really extreme weakness. And we can try to guess from one time frame, but we're not in the game of guessing. Right? We're not here to guess. We're here to scientifically, I use that for the gentleman over here, and all our engineer friends here, to scientifically actually look at something. I say that tongue-in-cheek because I know that a lot of people want control over the market. You can't ever have control. And one way, the fallacy that we can look at is through scientific measure and all this stuff. Just my opinion. But this way we can kind of go down and break the bar down and say, where did that volume come in? When we got up there, what happened? We could do that on market profile. We could do that on different time frame charts. But we have to do it. However you arrange to do it, you have to do it. Mary?
On this highest volume chart, bar chart right there,
Mhm.
it went down from, it went up on a little bit lighter volume. Could you just explain what that test was at the high volume bar?
You're talking right here.
Yes.
That's a hammer test. That's going to be a hammer test on high volume. You're going to expect, because of the high volume, you're going to retest that sometime. But you also are going to expect that that's going to form a support zone. So if I could take my thing over here about right, you can see where that market kind of at the same level right there, where my arrow went, and then it fell through, and when it fell through, then it continued down. But it did its job to the little extent that it did with that one bar. It stopped that one bar. That's what you're going to expect. But the real key to that story on that bar, because it's high volume like that, what we don't know is that demand overcoming supply, or is that saying there's more supply down there to be taken out? And you can see by looking at the after effects, it was the latter, that you had more supply that had to come out because of high volume tests. High volume tests, generally speaking, are going to be tests. It's been an area that's going to be retested. Not necessarily at the exact same bottom, but you're going to retest that area. Shooting star high volume again. Now that's high volume. Why? Yeah. And that's an afternoon session. Now that is E-mini after 2 o'clock Central Time. So that's 2:30. And to have that light of volume during that part of the day, leading up to that, that's pretty unusual. And all of a sudden, we get this come in versus the other bars before it, volume I'm talking, all of a sudden, this thing shoots up, takes out the old high to the left by a couple ticks, because they love to do this, and then it closes back down, forms a shooting star in high volume, and then you see the market collapse from it. And that's on a 5-minute chart. Now we got the S&P on a 15-minute chart. And again, that's a high volume shooting star. It's 1 o'clock in the afternoon. So this is a time in the afternoon that we're going to expect volume to start come back in from the lunch hour. And when it did, it's the same story again. And this is the 29th instead of the 23rd. And you see this happen, and it takes out an old high to the left by a couple ticks, and then down we go. This is what they do all the time in the E-mini S&P. It's just trying to trick traders, because traders are easily tricked. The retail traders easily tricked into thinking we got a new breakout. People love to buy breakouts, and breakouts, they work great in the 80s. I can tell you that. They worked awesome in the 80s, but they don't work so good anymore, especially in the E-mini. And now you've got the turtle traders that'll disagree with me and say, oh yeah, you take the 20-bar high out. And yeah, I agree with you if you want to take a 30% winner, right? 30% chance of winning and riding that thing. If you can ride that thing, good, do it. But you're taking a low probability trade when you're trying to do breakouts, because pretty much anymore they break down, not break out. And then one of our last charts here, this is back to my super charts. And this is wheat, and it's a monthly chart. And you all know what the grains have been doing, right? The grains have been going crazy for quite a while. And it's parabolic. See the parabolic move? What I mean by parabolic, if you put a parabola on this, you get your little art drawing tool. If you want to go to the art store and buy a parabola, go buy a parabola and put this parabola on your charts, and you're going to see when you start to turn up like that, you've got a parabolic move and it can't sustain. And this is what happened with wheat. Wheat had a shooting star. That meets the criteria of a shooting star. And let me point to this, because this does not have a line on it. This bar right here. A little harder to see than the E-signal charts. But it meets the criteria, I think, almost to the point of being a shooting star. That real body is just what it has to be for that upper shadow to be 2 times it. And that's a shooting star. But look at the volume on it. It's the highest volume bar on the chart, and this is a monthly chart. This goes back to 2005. But see what they did? This is the thing that they do. The next bar is not a shooting star, even though it looks like it is. It doesn't fit the criteria if we're measuring it the way that it's supposed to be measured with the rule set we gave. But they drive it almost up to the top again, almost up to that old high, and then slam it down again, because they're just trying to get people to take those positions off of them. Right? They got to get rid of their inventory. And then once you can see what it's all gone, we went from a high of, what, 1350 maybe down to about 750. It almost got cut in half in 2.5, 3 months after that. But this stuff, when you look at these long time frames and you see this stuff, and you see these shooting star high volume, shooting star really high volume, that's telling you something a lot different than a shooting star no demand. It's telling you supply is swamping demand. There's a reason it went up, couldn't stay there, and came back down, and you need to be aware of that. That market usually is going to fall. You're usually going to have a fall immediately. But in this case, again, it did. If you looked at that and you said, well, yeah, I would have still been in that, but if you traded that, I guarantee you wouldn't have held your position through there. There's no way. It would have been way too painful. You would have been right on your direction call, but wrong on your timing. And that's the art of trading. There's no way around that, right? All of your indicators would have still been saying buy there. You know, stochastics make a new high, and we don't have any divergences because we wouldn't at this point. Everything would look really rosy. But that's how professionals trade. That's how they take money from people. Okay, let's do a summary. Take our last break. Candlestick chart analysis can be greatly enhanced with Wyckoff volume analysis. I hope I've given you a flavor of that so that you can go and play with it when you get home. That's what I want you to do, is just go say, hey, I like these doji no demands, or I like those shooting star high volumes. I like those doji tests. Pick something and go with it. And just look at a lot of charts, looking for the one thing. Don't try to look at every chart and find everything on it. It's too hard to do that right now. Look for one thing, right thing. I'd say write one thing down right now that you're going to go home with, and you're going to say, I'm going to look at that. And then look at 100 charts and find all those doji tests on them. Find all those shooting star high volumes and see what the market does. Because you do have to prove it to yourself before you can trade it. You can hear every expert in the world tell you anything they want to tell you, but until you internalize it, you'll never trust it enough to trade it. And when you do finally say, well, I trust the guy that told me that, I'm going to take the flyer on it, that's the time where it doesn't work. And then you go, oh, geez, back to the drawing board. You know, another guy didn't know what he was talking about. So you got to prove it to yourself. By identifying the candle pattern and then observing the consensus view of the smart money on that pattern, we greatly increase the success of the pattern. These examples, just a few of the existing candle volume patterns that will emerge from my research. I'm working on this. I do want to have, eventually, a software package that will identify these patterns automatically. And what I'm working on right now is actually having these patterns identify themselves only in areas where we reach support and resistance. So we can say it is tradable now. It's not just theory, here's a shooting star high volume. I want to see a shooting star high volume where there's resistance, right there. And then I want to take that trade right now. Not say, well, this is what a shooting star high volume looks like, and now you go do the rest of the work yourself. I don't want to do that. I want to make it so it's as close to automatic as we can get it. I'm working with Trade Navigator right now to try to do that. And it's very encouraging. I think we're going to be able to do what I'm trying to do, but it's not finished. Right? This is work in process. It's something I've been working very heavily on for the last 9 months. And trying to get this thing to fruition, because there are a lot of people that trade candles and candle patterns, but they're not putting volume to them. There's software out there that'll say, hey, here's a bar, and they'll name the bar and say, okay, that's great, but what do you do with it then? You got it, there it is, but now what do I do? I want to make it different, where here's the pattern, here's the resistance, and here's where you short. That's where we're going with the research. So if you want to learn more and stay tuned about it, again, a little commercial more for the videotape now than the group here, but traderscode.com, visit it often. I'm going to have a lot of content that goes on there. These seminars will be on there, and then I'm going to do charts of the week that you guys can sign up for.